Imagine a law so powerful it controls how much money your bank can lend, how much risk it can take, and how it survives a crisis. Now imagine this law was never voted on, never made headlines, and was created in secret by a small group of men in a quiet Swiss city. This isn't a conspiracy theory. It's the story of the Basel Accords, the most influential financial rules on Earth. And the strangest part? Most people have never even heard of them. Our story starts in 1974. A small German bank called Herstedt goes bankrupt in the middle of a currency trade. Because of time zones, American banks had sent it money. But before the German bank could send funds back, it vanished. The entire global payment system froze. It was a wake-up call. Finance had gone global, but the rules were still local. In response, the world's most powerful central bankers gathered in Switzerland at the Bank for International Settlements, a private, neutral institution known as the Central Bank for Central Banks. There, they formed the Basel Committee with a simple mission: make sure this never happens again. It took over a decade, but in 1988, they unveiled Basel I. It introduced a single, powerful idea. Banks must hold at least 8% of their risk-weighted assets in capital. In plain English, for every $100 a bank lends, it must keep $8 of its own money as a safety cushion. For the first time, risk had a global yardstick. This wasn't technically law, but if your country didn't adopt it, no one in global finance would want to play with you. But its simplicity was also a flaw. Banks poured money into government debt instead of private businesses. It allowed large banks to use their own internal mathematical models to calculate how much capital they needed. It was like letting the fox design the henhouse. And the foxes got creative. Banks assigned laughably low risk ratings to complex, mortgage-backed securities, the same assets that would explode in 2008. The model said they were safe. Reality said they were toxic time bombs. When the 2008 crisis hit, the system built on these models collapsed. In the wreckage, regulators returned to Basel, desperate to fix it. The result was Basel III. It demanded higher quality capital, introduced new safety buffers, and forced banks to hold enough cash to survive a 30-day market freeze. In theory, it made the system tougher. In practice, the core idea relying on models and risk, the rules became a labyrinth, so complex only insiders could understand it. And the story isn't over. We're now entering the era of Basel IV, an attempt to close the remaining loopholes by putting a floor on how much banks can use their models to reduce capital. But with each new rule, the system gets more centralized. Small banks can't afford the compliance costs, so they get absorbed by the giants, the same ones deemed too big to fail. Worse, it creates uniformity. When every bank uses the same formulas, they all buy the same assets and react to the same triggers. This doesn't create safety. It creates synchronized fragility. When one domino falls, they all fall together. The Basel Accords didn't eliminate risk. They just disguised it, hiding it behind a wall of acronyms and complex formulas. They were created to make banking safer, but what they really did was make it invisible. And in finance, whoever writes the rules for invisible risk quietly rules the world. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.